Hey guys, in this video, we are going over 5 top stocks that I believe are quite undervalued in today's market. These are companies whose stock is trading below their intrinsic values, which means that in the long term, we will expect them to see significant upside in value. So watch all the way through if you want a breakdown of each of these stocks and why they might make you a lot of money. But before we jump into the stocks, I wanted to give you guys some background of what makes a stock undervalued. Undervalued means it's selling for a price that is beneath its true intrinsic value. This is something that Warren Buffett loves doing. And by analyzing a company's financial statements and looking at metrics like net profits, cash flow, P/E ratio, industry averages, and more, we are able to guess this intrinsic value. Guess is the keyword because it's an art and not set in stone. By looking for stocks that are undervalued, we are essentially increasing the chances of making money. We aren't looking at trading patterns or momentum. Instead, we are just trying to find stocks that are on sale and waiting for them to hopefully appreciate in value. So without further ado, let's get started on my 5 undervalued stock picks. The first stock on my list is Toyota, stock ticker TM. This is a Japanese automobile manufacturer that all of you guys have heard of. Right now, Toyota is trading at $183.84 with a 52-week low of $118.66 and a 52-week high of $184.88. If we take a look at the 1-year price chart, we can see pretty consistent growth from around $120, $130 1 year ago, all the way to over $180 right now, with a really big jump in the recent last couple months. Toyota has a market cap of $257.931 billion, a pretty low P/E ratio of 12.73, earnings per share of $14.44, and actually does pay a mild dividend of 2.45%. And Yahoo Finance's algorithm rates Toyota as a near fair value in terms of its share price. Now, if we take a look at some of the valuation measures, we can see that Toyota has a 5-year PEG ratio of 61.93 and a price to book ratio of 1.2. Their profitability is sitting at 8.25%. They have a return on equity of 10.14%, which is pretty good. And their yearly revenue is around $27.21 trillion. They're sitting on total cash of about $7.49 trillion and a current ratio of 1.06. There's not too much data from analysts, but from what we have here, we can see that analysts have rated it as a 1, which is a strong buy. And the average analyst price target is currently $187.76, which is a little bit higher than the current price of $183.84. Just this week, Toyota reached a historical milestone with the company's shares topping 10,000 yen for the first time ever. And unfortunately, it seems like it still has not reached its ceiling yet. To begin with, Toyota proved to shareholders that during a global pandemic and a chip shortage, it was still able to maintain efficiency and swiftness of its automotive production. After declaring that it profited by 10% year over year in 2021, in spite of the declining sales due to the COVID pandemic, Toyota also announced a 250 billion yen share buyback, showing that the company is confident in its ability to continue profiting towards the future. I'm confident in this company's future growth purely because as one of the world's largest and most trusted automakers, it's beginning to tap into the EV market. Also consider the fact that Tesla has a higher market cap than Toyota, yet Toyota sells 20 times more vehicles than Tesla. This is solely because the EV sector is brand new and it's still developing, but at the end of the day, Toyota is still selling more vehicles and therefore generating more revenue. To me, it shows that people are still sleeping on Toyota's future potential, and people also seem to underestimate the durability of the automaker that has allowed it to be one of the most successful automotive companies in the world. The next stock on my list is Mr. Cooper Group, stock ticker COOP. This is an American mortgage loan servicing company. Right now, Mr. Cooper Group is trading at $33.95 with a 52-week low of $11.47 and a 52-week high of $37.91. Their 1-year price chart shows consistent growth all the way from last year, all the way from under $15 a share to over $30 where it is right now. They have a market cap of $2.924 billion, a P/E ratio of just 3.15, and an earnings per share of $10.79. And the stock right now is currently rated as undervalued. They have a price to book ratio of 0.99, a profit margin of 27.78%, and a really great return on equity of 41.81%. In the last 12 months, they've seen revenues of $3.72 billion. And looking at their balance sheet, we can see that they have total total cash of $906 million and a very good current ratio of 3.36. Not too much data from analysts on this company again, but they are rating it as a 2.1, meaning it is a buy. And the average analyst price target is $40.86, which is about 20% higher than the current price of $33.95. So Mr. Cooper Group expects to be profitable for the rest of 2021, and there are several causes for this and several reasons why shareholders and future investors should be excited. For starters, the residential housing market continues to rise, and with low interest rates, this will likely lead to a lot more business for this company. They recently sold off Title 365, which was the company's title insurance and settlement services company, for $500 million. This is a good sale because it will add more money to the company's reserves that can be reinvested in other assets. The company can also now focus solely on mortgage servicing. And either way, the company's Zone business already offers title services, so keeping Title 365 would just be redundant and a waste of resources. And finally, Mr. Cooper Group recently struck a deal with Alphabet's Google Cloud to create an AI-powered digitalized mortgage servicing platform. This will create a lot of efficiency for the business, and it shows Mr. Cooper Group's dedication to improve its technology and keep up with the times. Since this is a well-established company, I think that the company's future continues to be bright. That plus the fact that I do think that this company is undervalued could mean that it is a good time to pick up some shares. The third stock on my list is Qualcomm, stock ticker QCOM. This is an American wireless communications tech manufacturer. So right now Qualcomm is trading at $134.95 with a 52-week low of $86.68 and a 52-week high of $167.94. Their one-year price chart shows pretty rapid growth from 1 year ago up until the start of 2021. But since then, we have seen quite a dip in their share price. They have a market cap of $152.224 billion, a PE ratio of 19.33, earnings per share of $6.98, and a mild dividend of 2.01%. Yahoo Finance is also rating this stock as undervalued. Now, looking at their valuation measures, we can see that they have a 5-year PEG ratio of 0.62 and a price to book ratio of 20.39, which is actually not good at all. Their profit margins are at 27.28%, and they have a really high return on equity of 153.25%. They're sitting on about $11.53 billion of total cash, and they have a current ratio of 2.02. Analysts are rating this as a 2, meaning it is a buy. And the average analyst price target is $171.30, which is quite a bit higher than the current price of $134.95. ClearBridge Investments reported Qualcomm as one of its large cap growth picks. According to the investment firm, Qualcomm is currently suffering due to increased exposure to a cyclical semiconductor industry that's currently working through a severe supply shortage. This supply shortage is not new and has long been expected to be an unfortunate consequence of the global pandemic. The most crucial thing to take out of this analysis is that Qualcomm is still suffering, and once the economy recovers, the company is expected to climb out of the valley that's currently in. In fact, the climb might have already started. As of the past 3 months, Qualcomm has delivered a 4.03% return. Recently, a JP Morgan analyst set a price target of $175 on Qualcomm, which implies massive returns of 30%. Qualcomm has continuously proven itself to be a reliable semiconductor company that is integral to the wireless tech industry. I don't think a minor supply setback caused by an anomaly like the global pandemic will completely destroy the company's long-term growth. That is why I am a long-term believer of this stock. All right, number 4 on my list is Honda, stock ticker HMC. This is a Japanese automotive manufacturer that all of you guys know. So right now, Honda is trading at $32.80 with a 52-week low of $23.10 and a 52-week high of $33.32. We saw their share price dip at the end of last year, but at the end of 2020, we saw a big recovery, and ever since then, the share price has been steadily going up. Honda has a market cap of $56.728 billion, a PE ratio of 9.45, earnings per share of $3.47, and a decent dividend of 3.12%. Yahoo Finance is rating Honda as overvalued, but I do disagree with that. Honda has a 5-year PEG ratio of 8.69 and a price to book ratio of just 0.68, meaning that it could be severely undervalued. Their profit margin is sitting at 4.99%, and they have a return on equity of 7.88%. They're sitting on total cash of $3.05 trillion, and they have a current ratio of 1.33. Not too much data from analysts, but right now they are rating it as 1, which is a strong buy, and the average analyst price target is $36, which is over 10% higher than the current price of $32.80. Honda is similar to Toyota in that it is another well-established and trusted automobile manufacturer. In fiscal year 2020, the company sold 4.8 million automobiles, a much larger number compared to Tesla's 500,000 vehicles. Now, Tesla is a company that should see its production numbers grow faster and faster over time, but the disparity in sales and revenue shows that Honda not only has a huge financial head start, but also has the resources to compete with Tesla. In fact, Honda has already taken big steps to join the inevitable EV revolution, becoming a part of the Mobility Open blockchain initiative to monitor carbon emissions from EV batteries. And of course, Honda wants to join in on the fun of creating and selling EVs as well. While Honda and Toyota have a difficult time manufacturing electric cars in a swift manner, their minds are set on doing whatever it takes to adapt and thrive in the global automotive industry. All right, the last stock on my list is the SPDR S&P Transportation ETF, stock ticker XTN. This is an ETF that tracks the S&P Transportation Select Industry Index. So right now, one share of this ETF is trading at $87.54, with a 52-week low of $50 and a 52-week high of $92.58. This fund has net assets of $648.95 million, a dividend yield of 1.17%, year-to-date daily total return of 25.57%, and a relatively low expense ratio of 0.35%. I know that's not as low as some of the Vanguard funds, but compared to many of the other transportation funds, this is quite good. If we take a look at the one-year price chart, we can see pretty steady growth all the way from 1 year ago until where it is right now. Looking at the sector weightings, we can see that 95.46% is in industrials and 4.54% is in technology. We also see an average price to earnings ratio of 22.6 and an average price to book ratio of 2.98. Some of the largest holdings in this fund include Kansas City Southern, Avis Budget Group Inc., United Parcel Service, and Atlas Air Worldwide Holdings. So the pandemic's not quite over yet, but its devastating effects have definitely been alleviated by successful mass vaccine distributions across the world. As a result, people will travel and commute more. So this ETF mainly tracks trucking, air freight, and logistics, and airlines, with airlines taking up 24.2% of the ETF's portfolio. This will probably be the biggest catalyst for this ETF's growth, especially during the summer when people are starting to travel more. We can also see that the index that backs XTN is performing better than the index that backs the iShares Transportation ETF, which is another very popular ETF for the transportation industry. Not only does investing into this ETF make sense considering that we're shifting to normal times again, but it also should be less riskier considering that it is an ETF that tracks a whole bunch of companies instead of just picking one. Personally, I do think that a lot of the companies in this ETF are undervalued, so that's why this could be a good time to pick up some shares of this ETF. Anyways, those are 5 undervalued stocks that I currently recommend checking out. As with all investing, I encourage you guys to do your own due diligence and don't buy a stock just because it was on this list. These are just my opinions. I'm not a financial advisor, so you want to really make sure that you understand what you're investing your money into. If you want 2 free stocks from WeBull or 1 free stock from Robinhood, I'll put the links in the description below. Happy investing. Hope you guys enjoyed the video, and if you did, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video. Peace.